Hi, what I'm going to do now is to move on to how we account for provisions quite generally. And what this requires us to consider in the first instance is what type of accounting standard is it going to be? Is it going to be an historic cost standard or a current value standard? To address this issue, we need to think about what is the nature of the liability and how does it fit within the business model, and are the cash flows fixed over time? Fixed in terms of amount and fixed as to timing. If they're not fixed, then it's going to make historic cost very difficult, and it's more likely to suggest a fair value, current value type approach. And that's probably what we should expect to see with provisions, because if we look at the definition of provisions, we'll see that provisions are uncertain as to amount and timing. So that moves us on to the accounting standard, and the accounting standard which addresses provisions generally is IAS 37, AASB 137, and we can see the scope of the standard in paragraph 1. And the standard deals not just with provisions, but it also deals with contingent assets and contingent liabilities. We should also move on to the definitions to see exactly what we mean by provisions, and a provision is a liability of uncertain timing or amount. And so, as I said a few moments ago, it's really going to make an historic cost approach to recognising provisions very difficult, nigh on impossible. We also see that a contingent liability is a provision which doesn't meet the criteria for recognition. So it's only a contingent liability, not a provision. And contingent assets are assets which don't meet the criteria for recognition also. But our attention is primarily going to be on the provisions. So what are the criteria for recognising a provision? These are addressed in paragraph 14, and you can see that for a provision to exist, there must be a present obligation. It must arise from a past event. There must be a probable outflow of resources, and it must be able to be measured reliably. You can see that I've just described those terms very generally, but you can get some quite detailed indications as to what they really mean in the related paragraphs, and you really need to read those. In terms of how we measure a provision, we're told quite generically to measure it at the best estimate. What is the best estimate? Well, a best estimate is the expenditure that is expected to be required to settle the provision or the obligation. Necessarily, it involves the exercise of judgment and uncertainties. And to resolve some of these uncertainties, you might use a probabilistic approach. In terms of what we mean by risks and uncertainties, it's addressed in paragraph 42. And because the settlement might occur for some substantial period of time, we are required to recognise these on a present value basis. So discounting is required. We also need to have some recognition of how future events might shape those obligations that we have. In terms of what we do or don't take into account in terms of measurement, well, sometimes we might be able to, when we're having some provisions, we might have to sell some assets, and we can't preempt the recognition of gains on disposal to reduce the amount of provision that we'd have to recognise. So you can't early recognise gains to reduce provisions. If the provision is able to be offset from another source, so maybe it's warranty provision and some other party is responsible for supplying parts to satisfy the warranty provision, then that would be a reimbursement of part of the costs of the provision, and that can be used to reduce the provision, and it can be recognised on a net basis. Future losses can't be recognised. However, onerous contracts which lock in losses can be recognised. Restructuring provisions are a little bit problematic because whilst we generally speaking have few impediments to the recognition of provisions, in the case of restructuring, because they've often been associated with cookie jar accounting in the past, you can only recognise restructuring provisions if there's a constructive obligation to do so. What that means, are you committed? You can't back out, and so therefore you have to recognise it. And in terms of how we recognise that, well, provisions are always subject to review every period, and any changes in the provision are going to give rise to an expense or a gain in the profit or loss. In terms of the change in the provision, some of that change will be a consequence of the reversal of discounting. In other words, if nothing else happens and you've discounted a liability, it will grow by the amount of the discount in the next year. So the reversal of discounting, well, it's an interest expense and that needs to be recognised as such, and you can only use a provision for the specific purpose for which it was created. So you can't use a redundancy provision for a warranty provision. They're different things. The disclosure requirements for provisions are quite extensive. They're detailed from paragraph 4084 onwards. You have to have a reconciliation of changes in the provision balances, a description of each provision, which details the nature, timing, and uncertainties involved in the determination of that provision. Also, whether it's subject to any reimbursements. Separately, you have to disclose contingent liabilities because whilst they may not meet the criteria for recognition, they still may be relevant for users of financial statements.